Hey, everybody. Welcome to episode number 10 of Migrate Your Money. I'm your host, Drew Feitz, certified financial planner and founder of Migration Wealth Management. And today I want to talk to you about tax write offs and some misperceptions around them. So let's dive in. People love to talk about tax write offs. It seems like social media has made a lot of us view tax write offs as a magical solution or a cheat code to save money on our taxes. But the reality is that a tax write-off isn't a cheat code or a guaranteed shortcut to financial success. Have you ever seen someone talk about the holy grail of tax write-offs on social media? Or maybe you've heard someone you personally know brag about something that they purchased with the intent to write it off on their taxes. The truth is, and fair warning, I'm sorry because I know that this is going to come off too strong, they probably don't know how tax write-offs work. Take this trade, for instance. If you give me $100, then I'll give you $25 in return. What do you think? Deal or no deal? No deal, right? This is the trade that people make all the time when they purchase something through their business just because it's a write-off. To understand this, first we need to set the stage with some technicalities of tax write-offs. A write-off is technically referred to as a deduction in the tax world. Most of the deductions that are spoken about on social media or wherever else you might hear about it are not available to individuals. The deductions that you often hear about on social media are available if you own a business. And no, you cannot open up an LLC to claim deductions if it's not a legitimate business that earns income, but that's an entirely different story that we're not going to talk about today. Contrary to popular belief, when you claim a tax deduction, you don't pocket the entire amount of your purchase as tax savings. A write-off simply reduces your taxable income, which in turn affects the amount of tax that you owe. Spending a dollar does not save you a dollar. So let's talk about the basics of tax deductions or write-offs if we want to continue with the term. To better understand what that means and how write-offs work, let's take a look at a simple example. Let's assume that you're a business owner and you pay for an office for your business that costs $2,500 a month, which is $30,000 a year. It could be any other expense rather than an office. This is kind of just what I chose for this example. While you may think that this office expense counts as a write-off that automatically saves you $30,000 in taxes, that's not the case. In reality, the benefit that you receive from a deduction is determined by multiplying the amount that you spent by your tax rate. So if we assume that you're in the 24% federal tax bracket, the actual deduction will be $7,200, which is the $30,000 that you spent on the office or whatever else it is, multiplied by that 24% tax rate. And to keep things simple, this doesn't factor in self-employment taxes or state and local taxes or whatever else there might be. You still had to pay for the office, and you only saved a percentage of that expense as taxes. Your cash balance still decreased by the amount of the office expense. It's important to note that the calculation can be more complex than this example suggests, as various factors can impact the final deduction amount. But this is just a simplified scenario that helps illustrate the concept that tax deductions don't equate to a dollar for dollar reduction in taxes owed. Don't let the tax tail wag the dog is a favorite saying among financial planners. So what does it mean? While tax deductions are beneficial and can make business purchases less painful, it's important not to let the pursuit of tax write-offs dictate your spending decisions. Your spending decisions in your business and in your personal finances should be made based on your cash balance, your cash flow, and your needs. Don't step over dollars, pick up dimes. There's another saying I had to throw in here that financial planners love. What does this one mean? Yes, you should take the deduction if you're going to pay for the office anyways, or whatever else the expense might be. But you shouldn't let the deduction lead you to paying for that office or spending that money. In our example of the $30,000 per year office, you only save 24 cents in taxes for every dollar that you spent. So in this case, I guess you're stepping over dollars, pick up quarters, not dimes. But I think the meaning of this thing is still there. That's all I have for you today. Overall, I hope I've made it clear that purchasing things solely for the sake of deducting them on taxes is not a good financial strategy. The primary driver behind your purchases should be their value and their necessity, not the potential tax benefits that they might provide. If you didn't catch on throughout the episode or at the beginning, I run a fee-only wealth management firm called Migration Wealth Management. I specialize in providing financial planning and investment management to people in their 30s and 40s. If you're interested in learning more, check out my website at migrationwealthmanagement.com. I've tried to make it really easy to learn more there. And if you're interested in scheduling a 1-hour intro and discovery meeting with me, you can find a schedule free meeting button at the top page of every page of the website. Thank you for joining me today, and I'll see you next time.
This podcast is for informational and entertainment purposes only and should not be relied on as basis for investment decisions. None of the information provided in this podcast is intended as investment, tax, accounting, or legal advice.